Good evening, ladies and gentlemen. Thank you very much for attending tonight. Great to see some familiar faces and some new faces. Welcome to what we're calling our inaugural Aged Care Summit. We hope that the information you're going to listen to and digest tonight is going to hopefully broaden your awareness and knowledge of the aged care sector. And to help you guys make decisions potentially for yourselves or for family members and loved ones, family or friends. So again, welcome. Just a couple of quick housekeeping notes. If you need to use the amenities, the restrooms, back out the hallway and upstairs. Find gentlemen's and ladies' bathrooms up there. And also in the event of an emergency, please make your way out the same way you came in out that front door. So again, welcome. We're here tonight to discuss all things aged care from the beginning to the end of the year. There's a big process that's involved with understanding that journey. It doesn't start at entering residential aged care from day one. It does take a bit of a journey, a bit of a process. And the more you're aware of that process now, as you maybe, like I said, go on this journey for yourselves or for loved ones, hopefully the better decisions you can make, be it financial or for the family at large. So, obviously tonight, anything we discuss here is general advice. What we would invite you to do after is reach out to one of the partners that you're connected with, be it Mirror Accountants or GSR lawyers or ourselves, Block Depot, and for us to sit down with you one-on-one and give you that bit more direct and tailored advice that will cater to your needs. Okay. So tonight we've got speaking with us a few illustrious panel speakers and guests, starting with Michelle from COASIT. So COASIT are a home support care service that also provide care services in the NDIS space as well. So Michelle's going to talk a lot more tonight about home care, how that works, the journey there, and that sort of process between home support into potentially residential aged care. Joined tonight by Marcus here from Challenger. So Challenger are a large financial product provider. They specialise in providing and building annuities that help support not just aged care strategies, but also retirement income. So really important. We have Mr. Alf Romano here. Some of you obviously know Alf. Our sort of go-to legal, the man that's been seen a lot in the world, and we definitely want to help a lot regarding our experiences with clients. We have Mr. Michele Romano from Mirror Accountants. Some of you may know Michele, and some of his team are here as well tonight, which is lovely to see. And Michele is going to focus on a little bit of tax strategy and asset structuring in the lead up to potentially looking at entering residential aged care. And touch on some of those trusts and structures that may be available to you. And then I'll round it all out with a bit more understanding about the new residential aged care reforms and how those numbers and those calculations sort of do work. I'll get Michelle up here first to lead us off. Welcome, Michelle.
Thanks.
Thank you.
I'm just going to give you a brief introduction to how to navigate the aged care system, because there was a few changes from the 1st of November last year, as you're probably all aware. Okay, so first of all, I'll just talk a little bit about COASIT. So we started off looking after a lot of the migrants that came from Italy and settled in Brisbane. COASIT stands for the Committee of Assistance for Italians, and it was later shortened to COASIT Community Services. The two main objectives of COASIT was to assist disadvantaged Italian migrants and to promote the teaching of Italian language as well. So our team comprises at the moment of over 500 people, and most of us speak several languages. And we assist people aged over 65 predominantly to remain living in their own home. So supported home. So this is a government subsidised home care program, and it all changed on the 1st of November last year. The supported home program took over from home care packages. So you would have heard about home care packages. There was level 1 through to level 4. So now supported home is actually 8 levels of care. So the primary objectives of the government changing home care packages to supported home was recommendations from the Royal Commission that occurred, but also to make services more accessible to clients, because people were just waiting too long to actually get any assistance at home. So it was their hope that it would shorten the time for people to get assistance. So number one is to make sure that you're registered with My Aged Care. So without being registered with My Aged Care, you won't be able to access any services, whether it's through the supported home program or the Commonwealth Home Support Program. So you always have to call My Aged Care and register. And I would also recommend that you also register a support person as well, because then if you're in hospital or you don't have capacity to communicate with My Aged Care, your support person can. So what happens is you register with My Aged Care, they'll ask you a series of questions. You will then be given your own identification number, and your support person will also be given their own identification number. During that initial conversation, they'll ask you a series of questions, and then they will determine which avenue of assessment you will go down. So there's a couple of programs that they may assess you for. The Commonwealth Home Support Program, which is entry level into aged care. Then they can also assess you for the Supported Home Program, which is the new version of the home care packages. And they can also give you approvals for residential respite and residential permanent care as well. So the goal, as I said before, was to reduce wait times for people to get assistance at home. Has it changed wait times? Yes, it has, but it has had a knock-on effect that now, instead of the government assigning the full funding to clients, the majority that are coming through, clients are only getting 60% of the funding. So that just means there's less money that's available for you to use for care and services. So that's where we talk about interim budgets. So 60% is the way the government is actually allocating packages at the moment. So upon approval for supported home, you're going to receive a notice of assessment and a support plan. So this generally is mailed out to you. And in this support plan, it'll have a bit of a story from the assessment officer. And then in here will be lots of codes that some of you may have seen. And there's codes and codes and codes for all different types of services. And then you'll have approvals and you'll have expiry dates when you have to take certain things up by. And it says, you know, you have to find a provider that can help you. So underneath the new scheme, the government has separated clients into 3 categories. So you have grandfathered clients, hybrid clients, and newbies. So the grandfathered clients are clients that were receiving a home care package prior to the 12th of September 2024. Or they were on a queue, so you'd been assessed, but you still hadn't received your package. So you were classified as a grandfathered client. The hybrid is anyone that was assessed and assigned a home care package from after the 12th of September, but before the 31st of October 2025. So you can see these dates are imperative. Date comes into alignment with some of the changes in the Aged Care Act that occurred as well. And then you have new clients, newbies, anyone that was assessed after the 1st of November 2025. So the reason why that they've separated into 3 participant types is all to do with your contribution rate, how much you have to pay for your care and your services. So the service list as well, the government has split into 3 categories. The first one being clinical, your things like your nursing, your podiatry, your physiotherapy. Second, they've classified as independent. So services such as your personal care, transport, respite in the home. And then you have everyday living. The most common, which is your cleaning, your meals. You might get meals prepared for you at home or meals delivered, like light and easy meals or gourmet meals, and gardening. So dependent whether you were a grandfather, a hybrid, or a newbie client, depends on how much you're going to pay for each of these categories. But one good thing that the government did decide on, that clinical sorts, the government said that you would not have to contribute anything, regardless if you're a self-funded retiree, a part pensioner, or a full pensioner. So that actually ended up being a really great thing that they decided on. But as far as independence is concerned, you might hear some providers saying to you, the contribution rates can fall anywhere from 5% up to 50% of the hourly rate. In everyday living, the contribution rate would be 17.5% up to 80% of the hourly rate. So when you're looking, the average of an hourly rate for independence and everyday living sits around $120 an hour. That can build up quite quickly. Whereas grandfathered clients, if you're lucky enough to be in that category, majority of those clients never paid anything out of pocket and will continue not to pay anything out of pocket because the government has said that they will not be in a worse off situation. So participant contributions, clinical supports, everyone pays 0%, which is wonderful. Independence, such as showering, anywhere from 5 to 50%, and your everyday living category, 17.5 to 18%. So the full pensioner, if you were grandfathered, so you were on a home care package prior to the 1st of November last year, you weren't paying anything out of pocket for any of those categories, and you will continue not to pay anything out of pocket, which is great. Part pensioners and self-funded retirees, they were paying something called an income tested fee. And prior to the 1st of November, that used to be in dollar value. And that used to range anywhere from $1 a day up to, let's call it $40 a day. And it really didn't matter if you had services once a week or once a fortnight. If you had an income tested fee, the government's expectation was that you paid that fee 7 days a week. Now, underneath the new system, you only pay, if you have an income tested fee, for the days that you actually have a service. So it's ended up being a lot fairer, and self-funded retirees and part pensioners have actually saved money now on the new system than the old system, because they're only paying that income assessment fee for the days that they receive services. So here the government says a no worse off principle applies to grandfathered clients, which is true. But new participant contributions is another story. So we've got the full pensioners, the part pensioners, and it also depends whether you hold a Commonwealth Seniors Healthcare card. That again becomes a different percentage if you hold a seniors healthcare card or you don't. And then you have the self-funded retirees. So some self-funded retirees that have actually been awarded a supported home package, let's call it, whether it be a level 1, 3 to 8. I've done calculations for them and they'd be out of pocket quite a lot every month. But if they only tapped into clinical supports, they'd be paying nothing out of pocket and purely utilising government funds. And then what we tend to do is put all the clinical supports underneath their plan and they pay privately for services such as showering or shopping, things like that, because private services don't have to run through the government pathway. So private services are only like $65 an hour versus $120. So there's ways around it. So here we have the supported home table. So you have the grandfathered clients, which are these ones here, where it's got level 1 HCP, home care package, level 2, level 3, level 4. The reason why we still have to work in this table is because there is still a lot of clients that are still working underneath the old home care package system with those amounts. But it's interesting to see when this new program started, we were all excited thinking that there'd be more money available to the community. But look at the old level 2 home care package, $19,224. The new level 2 is only $15,000. So the government actually reduced the figures. Level 3 was 41. The new level 3 is 21. Big difference. Big difference. So that was a little bit disappointing when the government introduced this table. Less money equals less services. So a couple of case studies, but again, everyone's very, very different. But a full pensioner, total income $35,000. Bill here of rents, he's only got assets of $10,000. He's been given a level 5 classification. What would he be contributing? Well, for every dollar that Bill contributes, the government will contribute on average about $12.90. So being a full pensioner on a supported home program, on a level 5, his out-of-pocket expense would probably be about $100 a month for general services. We have a part pensioner, total income $36,000. Sylvia here owns her own home. Her home's worth $850K. She has other assets of $200,000. Again, a level 5 supported home. So the government's giving her nearly $40,000 a year to use on care and services. For every dollar she contributes, the government will contribute about $6.10. And then we have fully self-funded retirees. And this is where the ratios aren't too good. Total income $66,000. Peter owns his home, worth 1.3 mil. 200,000 in other assets. Again, he's got a level 5 classification of about 40,000 to spend on care and services. For every dollar puts in, the government will only put in $1.60. So you can see with self-funded retirees, sometimes these, 1 to 8 levels of support at home may not necessarily be worthwhile touching, unless you're happy just to put clinical supports where you don't have to pay anything. Again, this case study, Harry doesn't have a Commonwealth Seniors Healthcare card. So it makes a little bit of a difference. His income, 100,000, he's a homeowner. His house is worth $1 million. He's got $500,000 assets, again, at level 5 for care and support. For every dollar Harry puts in, the government only puts in $1.20. So it's basically, you're not getting much at all.
For every dollar he contributes,
Yes,
it's giving a package.
yes.
31,000.
So basically his income tested fee would be so high that his contribution would not be worth him paying what the government's going to give him in return. That's why sometimes packages aren't worthwhile taking up.
Basically, it's 20 cents.
But in this new system, there has been 2 short-term pathways, which are well worth looking at. So the first one is the restorative care pathway. So generally you'll get approvals for this if you've just had a stay in hospital, and the social worker will generally push this through for you. And it used to be a lot more money. I'm pretty sure short-term restorative care used to be about $14,000 or $15,000 that you could use. They've reduced it to $6,000 and extended it to 16 weeks. So the government basically gives you $6,000 and you can use that. And the majority of people use this for equipment. So you can, end up getting beds. You won't get a very good bed for $6,000. Maybe wheelie walkers, recliner chair, ramps and rails put in the house. The other pathway is called end of life. So this is to support people who have 3 months or less to live. The government actually allocates $25,000 to be used. Last up to 3 months, that can be extended a little bit. But whilst you are tapping into these 2 programs, if you have a level 1 to 8, they actually will just suspend while you're using these programs. Once these programs are, especially restorative care, once that program is finished, then you'll go back to your 1 to 8 program. Again, though, these are income assessed. So I've had quite a few self-funded retirees come through end of life, and we've done the calculations and they've opted not to take on the end of life pathway. So with the assisted technology and home modifications, this is extra funding as well that the government can give you. There's 3 tiers: low, medium and high. The low is only $500. So it really won't even buy you a personal alarm. So if you are going to go for assisted technology and home modifications, try and aim high. Go for medium or high. Because low, look, to get an occupational therapist out just to do a report costs about $1,050. So, it's not going to get you anywhere. But what happens with the assisted technology, which could be your personal alarms, could be wheelie walkers, wheelchairs, the department will actually assess you and see what equipment you do need, and deemed on what you do need, they will then give you either $500, $2,000 and $15,000. You've got 12 months to use the funding, otherwise you lose it. So again, the way that they allow the money, whether it's the low, medium and high, depends on the risk associated with your care and your needs. So under the aged care system, there's several programs. You've got residential aged care. You've got the Commonwealth Home Support Program. You might have heard people saying CHIS. That's just short for Commonwealth Home Support Program. That's the program that has the most people nationwide. So that's entry level. And some of you actually might be on that program. It's where you might have a carer come in that does cleaning, and you might pay a contribution of $12 an hour because the government subsidises the rest of that hourly rate. Then you have a transition care program. This is short term. Generally, the hospital organises this for you. When you come out of hospital, you might have transition care at home or hospital at home, and it can last up to about 12 weeks. And that can be offered either in your home or in a respite facility, or actually in residential aged care settings as well. With the Commonwealth Home Support Program, which is the entry level program, you pay a small contribution, and this program is not income assessed. So a lot of part pensioners and self-funded retirees will opt to stay on this program because you just pay a contribution of $12 an hour, something like that. But unfortunately, the government is going to end this program they're saying about July 2027, because their aim is to make everything income assessed. So everyone will be paying for services regardless. The CHIS services offers just about as much as the supported home or the old home care package program. And it's very affordable. The only problem is you're limited in the amount of hours that you can access, because you have to think for each of these services, you've got to think there's a bucket of money for each one of those items. And let's just say with COASIT, we rely on the government to tip in maybe $2 million into the cleaning bucket, another $1 million into the personal care, a couple of million into the allied health bucket. But that bucket has to service 5,000 people. And if the government doesn't tip more money in, you might ring COASIT and say, oh, look, we've got a code because I've got all these codes written down here. Can you please help me with allied health? And we'll say, I'm so sorry, we're at capacity. Our portals will shut. All that means is that bucket is empty because the government hasn't put any money in. And what's been happening the last few years is the government's been putting less and less money in. Hence, the release of this new supported home program going from 4 levels to 8 levels, less money, only giving 60% of the funding. So yes. Private services is very popular because you're not reliant on the government. You don't have to wait. If you need something urgently, you pay for your services. Simple as that. So all services can be provided under private. Some people still take on CHIS and they still take on the home care package or supported home, and they supplement or top up with private services. And that's purely because there's just their approval isn't enough for their needs. And this is what we're finding, that when the assessment officers very rarely will come out and meet you face to face. They will ring you over the phone And then you could be, I would look at you and say, you know, you're a level 6 as far as I'm concerned, because you've had the assessment done over the phone, you're going to get a level 2. And a level 2, really, when we're looking at a level 2, you're probably looking at about maybe 3 hours of assistance a week. And that's Monday to Friday, not weekends, because weekends, the hourly rates are like $300-400 an hour, like they're huge. There's also daycare respite centres, which are very popular. With Support at Home, I do also advise if you want value for money as far as respite or a cared one, going to a respite centre is well worth it because you get a bulk amount of hours of someone looking after your loved one for not much more than 1 hour of normal hourly rate. So this is a good option if you're ever looking, if you need more assistance at home and you don't have the money in your budget, looking into respite centres, and it's just a day. The bus comes and picks you up in the morning, you go to the respite centre, there's morning tea, there's lunch, you can have a glass of wine, there's different activities, and the bus takes you back home. But your loved one's gone for about 6 hours and it costs about $180 for the day. That comes out of your package. So to me, that's well worth it. So there's ways that we can work around how to maximise budget. Other programs that you can tap into is, there's counselling that's available through different providers, dementia advisory, QCSS. It's for under 65s. So under 65 years of age, you can also have government funding to help with services. There's technology classes, there's dancing classes, exercise classes, art classes, yoga, cybersecurity, seniors. So there's lots of different programs and information out there to assist people. That's about it. If you have any other questions, please come and see me later on. But there's just so much to go through, and thank you very much.
So, Mark, if you come on.
I'm Marcus. I work for Challenger, and my role basically at Challenger is to meet with financial planners. Challenger offers a lot of financial product solutions to help people who are retired or in aged care, but I'm not tasked to talk about those today. That's for your financial planners to speak with you about. What I'm going to talk about is residential aged care. So we've just talked about home care. So that's receiving care in the home. I'm going to talk about if you actually need to go into care at a facility, and what that means for you and why it's so important. Now, this is a chart that I use quite a bit to just set the scene for what is different when you're a person who's accumulating wealth to a person who's retired and now drawing down on your savings, and then ultimately getting to that point where you might need aged care or think about the end of your life. And I won't harp on about this too long, but what people see their retirement journey as, and this is a very simple representation of it, is that I retire, I travel quite a bit, I do some improvements to my home, my kids have their kids, so now I have grandkids, and then I sit in a rocking chair and I die. So that's retirement in the most.
Well done.
In reality, all of these things happen, and no doubt a lot of fun things as well. But in my role, I'm tasked with talking about aged care, which lends me down the side of being a little bit more morbid. But all of these blue sections are actually needs for you to consult with some kind of financial professional, whether it be your lawyer, your accountant, your financial planner, because when these things happen, things change. And one of the biggest things that's going to happen, or a few of them, is you'll have change in health. You might have a relationship change, and that might be that one member of the couple's passed away. You might relocate to be close to your children because you might need your children to start looking after you. You might need to make modifications to your home because your mobility's been impaired, and then preparing for aged care. And so preparing for aged care, as I'm going to go on about, can be quite a costly exercise. Aged care is not cheap, particularly when we look at residential aged care, but for some, it's actually a non-negotiable. It's something that might happen when you go to hospital. Hospital will say, I'm sorry, but you can't go home. But you need to go into a facility. And so when I'm speaking to people like this, I recognize that this is not necessarily going to be you right away. So you're not planning necessarily for yourself. But I imagine all the people in the room know or have known somebody that is in residential aged care, or perhaps you've had a conversation with somebody or you have a loved one and you've identified perhaps a need that they may need some kind of help. And that help journey starts at home. And they may be receiving a home support package, as we just looked at, but you might have this Christmas conversation, and Christmas has just been, it seems like an eternity ago, but Christmas has just been, and Christmas is the time when we see all our loved ones again, particularly the elderly people in our lives. What we find in the aged care industry is that a lot of entries into aged care happen after Christmas because people, family members and friends have identified health needs of people they know. And then perhaps started the conversation. And now I'm going to start the conversation with you as when you identify those needs, perhaps where do you start? And then what does it look like when we get to residential aged care stage? So there's bits and pieces of wording here. What I would look for though, and to think about is those people you know and that you're planning for, it might not be obvious and it might not be immediate. My wife's grandmother, for example, she lives with my wife's parents. She's not particularly well, but she does need a little bit of help. What will happen to her inevitably is that she is starting to deteriorate, so she will have a care need. She's gone through this process of getting what they call an ACAT assessment. So that's the aged care assessment team. And they came out to her house, they asked her a number of questions, they identified her needs and approved her for a level of home care. So that's what we've just been through. So somebody can now come and give her support in the home. That will ultimately get to a point where she can no longer be in the home and receiving care from my wife's parents and the people who support her under a home care package. And she may need to go into what we would call a residential aged care facility. And when she does that, she's going to need to get assessed again. So she can do that voluntarily, or my wife's parents might instruct that on her behalf if she's lost capacity. Or if something happens and she needs to go to hospital, sometimes that ACAT assessment will be done at the hospital. So they'll have somebody that will approve you effectively for residential aged care. But that's the first step. If somebody wants to go into residential aged care, they have to be approved. So, sorry, I thought that was going to be something different, so I jumped back. But where I would go first is to the My Aged Care website. And I would always direct people here because it's the government's website for giving you all the information that is at a very high level about what aged care is. This is also where you go to get a voluntary ACAT assessment. So you have to register through this to be able to get that assessment for residential aged care. You can also look on here for different providers of residential aged care in the area where you live and see how much they cost. And I'm going to get to those costs right now. But before I do, I've sort of jumped the gun a little bit here, but people over age 50, 60% of people over age 50 are worried about paying for residential aged care. And like I said, it is expensive. Think about it like this. You have a house that you live in. You're going to have to buy another house and go in there and somebody's going to give you nursing care in that house. That's effectively how residential aged care works. And so a lot of people who go into residential aged care have to sell the house that they were living in to be able to afford to pay for the aged care service that they're going into. The people are worried about paying for care. And then what happens if you're a member of a couple and one of you needs to go into residential aged care? You still need to buy this other house, which is your aged care facility that you're going to receive care in, but you can't sell the other one because your spouse is living there and they're healthy and they have a number of years left. So the advice around that can become quite complicated, and it is very important that you see somebody to get that advice, because structuring that incorrectly can be quite detrimental to a financial position. So let's look at the costs of care. best way to look at this, and we've talked about this 1 November date, is this is when the aged care rules changed, and this is when the aged care costs changed. So the top line and everything that's in the grey shaded boxes is the old rules, and everything in the green are the few things that have changed. And I'm going to quantify this in a minute, but just to be very conceptual about it for you, when you go into residential aged care, like I said, you have to buy another house, and they call that an accommodation deposit. So if you go into a facility, they're going to advertise an amount that you need to pay for an accommodation deposit. It's called a RAD, a refundable accommodation deposit. You can choose to pay that, or you can choose to not. Most of them around Brisbane are between 600,000 and $1 million. So is what I would say. 600,000 is on the very low end. They go up to about 1.25 million in Brisbane. Forget the sort of $758,000 number for the minute. That is effectively a base level that facilities will start to charge as we move forward for that RAD. If you choose not to pay your RAD, you basically rent the bed. So I'm not going to buy this room, I'm going to rent it. And that's a 7.61% interest on whatever you have it paid at current date. So that rate changes from time to time, but at the moment it's 7.61%. So let's just say my RAD or the accommodation was $500,000. If I don't pay that $500,000, I pay 7.61% on having not paid that. So it's like having a home loan, but at a slightly higher interest rate. So that'll cost you about $37,000 a year. The next, so that's accommodation. I either rent the bed or I buy the bed. The thing that has changed there is once you've bought the bed, so I bought that bed for $500,000 and now I'm going to stay there for the rest of my life. The facility used to refund that refundable accommodation deposit back to your estate in full. So I paid $500,000. Once I've died, my estate gets $500,000 back. The rules have changed to the facilities are going to keep 2% per year for up to 5 years of that RAD. So in the example I gave of 500,000, they're going to keep $10,000 a year of that for 5 years. And that's 2%, isn't it? Yes. For 5 years. So up to a maximum of 10% is basically where I'm going. If the resident stays there for 5 years, facility is going to keep just under $50,000 of that. I won't get into how that's calculated on a daily basis, but the basic daily care fee, and now we get into the cost that everybody pays on an ongoing basis. So we funded our accommodation, and that's just to get our seat in the room. That's just to get our bum on the bed before any of the care is taken care of. Once we start getting care, we've got this basic daily care fee. Now, everybody pays the basic daily care fee at $65.55 a day at the moment. That indexes as well. So every year on the 20th of March and the 20th of September, these fees all index, but it's 85% of the full age pension. So if you're a full age pensioner, that's going to eat up 85% of your full age pension. The means tested care fee, so basic daily care fee remains unchanged under the new rules. What has changed is we used to have this means tested care fee, which we still have. It just has two names now, and it's means tested slightly differently. The means tested care fee is that if I have more money, I pay more. If I have less money, I pay less. It is the crux of it. That's been split into two fees now, such that the first fee, the hotelling supplement, pretty much everybody pays, and I'll get to who pays that. And then the non-clinical care contribution is your main means tested fee, and it caps out at about $105 a day. The hotelling supplement contribution kicks out at about $22 a day. So all in all, and I'll get to the numbers in a minute, these fees can cap out at about $70,000 a year. So that's after you've bought your bed or rented your bed. The rest is about $70,000 a year. And I'll get to the asset levels that you need to have to be paying that. Extra services fees, they remain more or less the same. So a lot of facilities will say, if you're going to stay here, we've got these extra services we can supply, and they'll cost you $10 a day or $20 a day or whatever it might be. Some facilities will give you an extra glass of wine with dinner or Foxtel or a choice of a couple of newspapers and things like that. It's not a glamorous thing, the extra services fee, but what has changed there is actually for the better. They've called it a higher everyday living fee. And the important part about this is that the facility can't mandate that you pay it. So previously, a facility would say, if you're going to stay here, you're going to pay this extra $20 a day for extra services, and we're going to give you not much. So that's what facilities used to do. Now they actually have to itemize what you're going to get for your $20 a day that you're paying extra and give you the opportunity to opt out. So you'd be like, I don't want those extra services. I don't want to pay for them. Then you're within your rights. You weren't previously within your rights to be able to do that. So this blue line along the bottom here is what the old fees used to be. The numbers are a little bit small, but I'll give you the gist of it as we go. Basically, the more money you had, the more you were going to pay for your care fees in a very straight line, right up until you had about $2.2 million in assets, and then you were paying the maximum care fees. So this is after you funded your accommodation. It doesn't include any of the accommodation stuff we talked about, buying the bed versus renting the bed. This is just your ongoing cash flow outside of that that's going to be required. The worst affected people here are not the people at the low end, which is good. So there's this concept of low means in the residential aged care system. So those are individuals with less than about $210,000 in assets. They don't pay the new non-clinical care contribution and basic daily care fee. All they pay is, and hoteling fee. All they pay is that basic daily care fee, which is 85% of their age pension. So the government knows they can afford that and they take a reasonable amount of it. As you go up in means, so you can see the orange now is the new rules. So New York people who've entered care after 1 November of last year. There's a steep curve at the start. So that's when we start paying that hoteling supplement. And then the steep curve that starts at about 550, 540,000 is where that non-clinical care contribution kicks in. And it's really steep means testing. So means testing is the amount of wealth you have, the more you pay. So as you have more wealth, your fees step up quite dramatically. And once you've got $1 million, and it's just over $1 million now, after a couple of indexations, you're paying the maximum fee. The maximum fee you used to pay was about $58,000 a year, and it capped out at 2.2 million. The maximum fees you will pay under the new rules cap out at about 70,000 with $1 million in assets.
The assets you're talking about includes the home?
The assets I'm talking about, the home's complicated. Good question.
Sorry.
Yeah. I'll come back to the home. These assets include the amount you pay towards your RAD. So I'll give you a really good example, and the home example is a great one. So if you sell your home, you're an individual, you're living in a home in Brisbane that's worth $1.2 million, let's say. You might have $300,000 in super in the bank. You've got $1.5 million if you sold that home and paid your RAD. So a lot of people, as I said, are going to need to buy their new bed, which means they've got to sell their old bed, which is the house they're living in. So if you've done that, I've gone and sold my $1.2 million house. I've paid a $700,000 RAD. So now I've got 500 grand extra in the bank, plus that 300 grand I already had there. All of that money, even the amount that I contributed to the RAD, is assessable for these fees. The amount that you contributed to the RAD, though, is not assessed for age pension. So it's assessed as if it's your home. So your home that you live in for age pension is exempt. So this is effectively your new home that you live in is exempt from age pension if you've paid your RAD, but it is assessed as part of these fees. If I use an extreme example, you had no money in the bank, you had to sell your home of $1 million to go and pay for your $700,000 RAD. Now I've only got $300,000 in the bank, but you're telling me I have to pay $70,000 a year in fees. That's exactly the case. That's what's happening. So but because you've paid $700,000 RAD, that money's sheltered from Centrelink. So you're probably getting the full age pension. And for a single person or a couple separated by illness, that's about $30,000 each. So at least $30,000 of that's going to be subsidised by your age pension. And the other 40 grand is going to come from your other assets. dig into the numbers a little bit more so you can see what this looks like. And I'll come back to the family home again just towards the end, but very low amount of assets, very low amount of fees is what we see here. So you've got 250,000 and that includes everything. If you choose, so if you're, I'll start with a couple. If you're a couple, you have your family home, one of you needs to go under care. Your home is exempt from these calculations because it's occupied by what they call a protected person. So that's your spouse still living in the home. The government says you can't reasonably sell that home because somebody that's protected, so a spouse is considered a protected person, lives in it. So it remains an exempt asset. So for those people who are retaining the family home, one member of the couple is going into care, your assets might actually not be that much. And so your means testing might not be that harsh. If you are a single person, and you were the only one living in your home, you didn't have a carer that was living there for a number of years and you didn't have a spouse. Once you leave and go into residential aged care, your home is assessed up to what they call the home cap, which is 210,000. It's exempt for Centrelink for 2 years. This is where it gets complicated. So this is why we need the professionals in our corner. But as soon as you sell that house, it's your asset. So that's money that's going to count towards these things. So we will see strategies where people might choose to retain their home for a little while because it's worth more than the assessment that it's getting capped at for aged care at 210,000. We might have people that are renting out their former family home, but to the detriment perhaps of the cash flow they're going to have to endure for having not paid their RAD. So remember, if I've got a $1 million RAD, I've got to pay 7.6% on that. That's going to cost me 76 grand a year. I probably need to sell my home to be able to pay that rent. And then we look at all these other care fees along the way. So like I said, they cap out at about $1 million. Aged care advice. And this is probably the most important part, I think, about having this conversation is when I speak to financial planners, they're mostly giving advice to people who are powers of attorney for those going into care. Sometimes they're speaking to the individuals that are planning early for residential aged care, but often in a case it's the 50 to 65 to 70-year-old kids that are helping put mum or dad into residential aged care that they're speaking to. And these are all of the things that go into residential aged care advice. And so you need a number of different people in your corner, and I would advocate for all of them. It's not as simple as it's going to be easy just to sell my home and pay my RAD and go into care. How then do I fund that $70,000 a year cash flow? Maybe there are things that I can do to reduce my care fees, reduce the assets that Centrelink and the aged care system can see. Maybe I can increase my age pension, reduce my care fees by some kind of strategic things. I need to think about what's happening with my estate. What are my beneficiaries going to get when all of this is rounded out? So I need a lawyer in my corner. I need to make sure my wills are up to date before I go in, my power of attorney documents so that I can speak to a financial planner about getting mum and dad into care, so that I can get them into a facility. All of these things are very, very important. Accountants for tax and planning ahead of time and afterwards. And then your financial planners, I see certainly as a project manager for the whole thing. Financial planning is a strategic role, and these are the people that I work with most closely. Financial planners don't just invest people's excess money. They'll go through everything from where you want to go into care, how are we going to make sure that you can fund your cash flow, structure your assets, work with your accountants to make sure that your tax strategies are not producing an unnecessary tax strategy for you. What are your beneficiary goals? Where do your kids like each other? What happens if the estate blows up? All of these kinds of things. Your financial planner is your project manager of all of these professionals that you need in your corner. And these are all of the things that happen when you go into residential aged care and that you need. And so I always advocate for financial advice. I'm not a financial planner, so there'll be a disclaimer here that says that everything I've told you is untrue and you can't sue me. But I've worked with Sebastian for a number of years. Fantastic financial planner. So please reach out to him and the other professionals you hear from today if you have any questions. Thank you.
All right, thanks, Sebastian. So, Aged Care Summit 2026. Today we're talking just briefly about asset structuring and things we need to do before we go into obviously aged care and some strategies. So we've heard from the guys here about these different things that we have to think about, and it is our reality. And what you'll see in a second is something about a 5-year kind of window. So let me just jump into it quickly. So a little bit about me. When I'm not here, I'm off on the field coaching a bunch of under 17-year-old girls. Interestingly enough, my CV, I don't have a lot on there about retirement planning. So my business partner does a lot more of the retirement planning stuff with Sebastian, but he wasn't able to make tonight, so I've jumped in his space. So please don't ask me the hard questions. I'll try and help where I can. A little bit of our firm. So we won some awards back in 2017. We're a zero partner firm, and it's a bunch of guys all looking good out front of the building. A little bit about what we do. So we are predominantly accounting and tax agents. We do a lot of work in business strategy. We do have a bookkeeping arm, and down the bottom we do have a tech consulting side as well. So clients want to build apps and that sort of thing, we can help with that as well. All right. So here we go. So well, time is ticking. For those of you who are thinking about and looking at this aged care space, what we need to think about is essentially 5 years from now. Reason for that. The slide here just basically talking about assets. So structuring assets into trusts before entering aged care in 26, we're navigating strict deprivation gifting rules and complex mean testing assessments. Now, obviously, trusts offer asset protection, and tax last minute transfers can obviously cause problems and reduce aged care fees because of obviously settling what we've heard. So we have about that. So what does this mean? So asset structuring in trust before entering aged care can be complex, strategic process designed to protect the wealth, reduce needs, care fees, which Sebastian will talk about later on, and maximising government entitlements like the age pension. In Australia, this basically is generally involving moving assets out of your personal name and into a trust structure, such as family trusts. So there's a number of you who've got trusts set up. In specific case, we talk about special disability trusts, SDTs, to alter assessments, obviously the income and asset level. And I just got that note there. Obviously, these strategies must be implemented well in advance, ideally 5+ years, to avoid that deprivation of asset rule, where the government continues to assess you as owning those assets. Really, in terms of tax strategies, aged care centres on reducing assessable income and assets, obviously to lower the means tested care fees and maximising the age pension. Some of the key 2026 thresholds and changes. So some of the changes that happen up there, the gifting limits. So they've gone to $10,000 per financial year with a maximum of $30,000 over a rolling 5 years. We heard about the hoteling supplement. So that applies if assets are greater than $238,000 or your income is greater than $95,000 indexed. Also heard about the asset cap home. Forgive me if these numbers are not 100% correct, but I think they're pretty close. Capped at $206,000 for means testing, unless a protected person resides there. So we talked about spouse being a protected person. And we heard about the RAD retention. So again, facilities may retain 2% of the RAD per year for up to 5 years, capped at 10%. So yeah, it's there's a bit of double up information here, but just so you understand, these are the changes that have happened. One of the critical warnings that we always put down here is that whether you like it or not, the ATO is obviously got a big focus on family trusts, and specifically targeting obviously income splitting. Okay, so it's all about trusts where we're earning an income and we decide to split that income with our spouse, obviously to minimise taxes. Family trust elections is another one. So generally have situations where you'll have a trust that has an income, so a profit, and you'll have another trust that has a loss. And a lot of people are forgetting to do these family trust elections to actually offset the loss against the income. So again, these things are coming under a lot of scrutiny. Alf will talk about trusts in more detail, but something to really think about. So some smart tax and investment strategies, these things here. So essentially the ones that we look at to manage wealth tax effectively, your testamentary trusts, special disability trusts. The two are different, obviously. So the testamentary trust is established via a will. And again, this is something that Alf will run through with you. But these trusts allow for tax effective income splitting amongst the beneficiaries. Okay, so it's basically imagine grandchildren getting taxed at adult rates. It also protects the inheritance from the beneficiaries' own potential future aged care costs. Special disability trusts. So again, they offer significant concessions. Basically, you can get immediate families can gift up to $500,000 into an SPT without triggering standard gifting rules, as we mentioned before, and provide specific eligibility criteria. The third one, the family home exemption. So keeping the family home obviously can be a powerful strategy. As we heard before, though, it is a little bit tricky. In 2026, if a protected person like a spouse or a carer live in the home, it is exempt from the asset test. Okay. But if no protected person is present, then we're only dealing with a capital amount of $206,000 being counted. And as we know in Brisbane today, the average value of a home, we're looking at about $1 million. So it's not going to really work. The last part there with investment bonds, and again, this is something Sebastian will touch on a bit more, but they're internally taxed at 30%. And they can be held within a trust as well. So if you hold it for 10 years, withdrawals can be tax-free, which obviously may simplify some income for aged care purposes. A couple of other trusts that we talked about down the bottom, special disability and testamentary trust. The two at the top are an interesting one as well. So irrevocable trusts. So they're placing assets into an irrevocable trust can remove them from your personal estate, which basically means that they're not counted when determining your eligibility for government-funded aged care or aged pension. Family trusts, discretionary trusts. So these are normally used to manage income and assets, but the important one with this is the control. Okay, so if you have a family trust set up, discretionary trust, if you are the controller or the appointer of the trust, then the assets within it may still be deemed to be caused by Services Australia. So essentially what that is if I go set up a Romano Family Trust, then I have me personally as trustee. I am the controller, and so therefore I am subject to that. I think the same case would apply, Sebastian, if they have a company as trustee and then I'm the director of that company, the same issue would apply. Special disability trust we've touched on before, but again, valid for people with severe disabilities. I haven't set one up. Sebastian, have you done any of those?
Especially,
You have a couple. So they are off significant concessions to allow family members to transfer the money. And as of 2019, I think, without deprivation rules. So that's the SPDP. The testamentary trusts, again, they're established with a will and they can protect assets for beneficiaries, potentially minimising the impact of aged care fees over time. And again, Alf will pretty much spend a lot of time talking about the testamentary trust. So this one here, we're talking about asset structure and aged care fees. And again, we talk about the 5-year rule. Okay, so the 5-year rule, we're basically talking about assets transferring to a trust within 5 years of entering aged care can typically, or are typically treated as deprived assets, which means that they remain in your asset test for 5 years from the date of the gift, which increases the means test care fees, even though you no longer own them. Okay. So it's very important. If we're thinking about today, fast forward 5 years, it's essentially we need to start thinking about these things now to look at how we can have these strategies to work for us. Deprivation of assets, what does it mean? Well, it's basically you transferring assets into a trust within 5 years of entering care, being still counted as assets for means tests. Okay, so effectively anything you do now in the next 5 years will come back and technically bite you. Control versus ownership. Again, same thing. So Centrelink will assess the trust assets based on who is the controller. Okay, so like I said before, it's the trustee of that trust, or the director of that company, it's trustee of the trust that essentially legally owns the assets. So again, if you're the appointer, those assets may be attributed to you.
You keep using that word may. Might be the key. There must be.
So based on,
Judges that.
based on the strategy, so essentially, if we were to set up if you've got a family trust, and again, I'll talk about this, Sebastian will talk about as well. It's trivial to you if you are the person. However, if you're removed, so for example, if we did a deed of renunciation down here and we removed that person from the trust, then they would be exempt. Potentially even the trustee, so there might be two trustees of that trust, and so you may remove one of those personal trustees. But effectively, it's only used.
But in basically, if you're a beneficiary, trustee, and want to appoint as a person with the power to appoint a trustee, the Social Security Department thinks that you've got that asset. So you're basically an employer. And doing that can create.
Obviously, there's capital gains tax implications as well. So it's
So you need a third party to be the.
potentially, yeah, it's not this thing. It's not an easy world to navigate through. So yeah, but like I said, yeah, a CGT situation, stamp duty. So if you are thinking about selling various properties into trusts, there is going to be a capital gains tax and a stamp duty consideration, and that could be huge. So you have to really think about that, and that's why it's not something that you can take lightly. You have to talk to all the advisors and get the right information. Asset reduction strategies. So Sebastian told me not to speak about this because he's going to follow and carry on with it. But essentially, reducing the value of assets can lower the means tested care fees and potentially increase your pension entitlements, as we heard before. Income management strategies. Again, same thing. So yeah, how do we lower our assessable income? Well, going through these different strategies to reduce that income tested components so you can get your age care fees. Tax offsets. So most of the people who are in that level there, the senior and pension tax offset remains a key tool for us in 2026. Single persons can provide a maximum offset of $2,200, potentially increasing your effective tax-free threshold to roughly $35,000 when combined with low income tax offsets. And that hasn't really changed. I mean, that's fairly straightforward. Touched on the timing of the family home and when we decide to sell it. So the 2-year exemption obviously applies. The home is automatically exempt from age pension asset calculations for 2 years after preventive care. And we have this notion again of the protected person rule. So it's essentially the person that's living, the spouse is remaining, obviously living in the house or the long-term carer. If they continue to live in the home, then it's 100% exempt from both pension and age care assets. Now, obviously, CGT exemptions apply to main residences. So if we're selling our main residence, we know that capital gains tax there, but proceeds will become fully acceptable assets once the 24-month reinvest period expires. So I think, Sebastian, you probably touch on that as well with regards to that sort of 5-year window as well, how that applies. So yeah, just some things to think about, steps to take. So obviously we're on that journey together. Seek professional advice, engage a financial advisor specialising in aged care to navigate all the tax, legal, social security rules. You'll see after listening to Alf as well that we should review our estate plans, update our wills, powers of attorneys to align with obviously our new trust structures we've put in place. Timing is everything as well. Begin planning at least 5 years. So if you've got anything out of my discussion tonight, 5 years, that 5-year number is important. To try and move assets into different vehicles to avoid penalties. And the last thing there, just considering annuity. So these can be sometimes used to provide steady income for you while you're reducing your total assessable assets. It's just a disclaimer there again. You don't use any of this against us. I just made it all up now. Should be right. But yeah, it's one of those things we have the team around us to obviously support us with all the information we need going forward. So I think, like I said, we're all in this journey together. If you want to go away from here and have a think about what needs to happen next, definitely reach out to Sebastian, and with Sebastian's help point us through to the right people. So thank you very much.
Thank you, Miguel. I'm going to invite Mr. Alvaro Romano now to come up and talk to us a little bit more about this concept about testamentary trust, which are going to be a very important part of your estate planning, potentially, if you haven't already considered it. So, El, Come on up.
Thanks, mate.
Thank you.
Thanks very much. Thank you, everybody. Thanks for coming tonight. As Sebastian said, I'm going to talk about estate planning, in particular about testamentary trusts. Now, I know that's really not to do with aged care in a sense, because it's talking about when you die. But it's a very important thing that everyone needs to think about. You'll see I'm going to talk about a case study scenario just to give you an example so that I know everyone's facts are different. Obviously, you need to get separate advice when you look at your own circumstances. But I'm just giving you a simple example of a mum and dad, age 60. They've got 2 kids that are over 18 and they're married, and they've got 5 grandkids, 3 from one child, 2 from another. Okay? That's the sort of standard thing that I come across most of the time. And most people say, you know, they're going to do their will. I call them an I love you will. I love you will means I love you. It's all yours. See you later. I'm gone. Right? That's the sort of standard thing. What most people do is the spouse leaves it to the other spouse. That's the normal thing, first step. And you appoint that person the executor. If that spouse is already gone, the will say now the next step is it goes to my 2 kids equally in their names absolutely. Okay, that's the second normal step. And then it'll say that if any of my children have died already and they've left 2 grandkids or 3 grandkids, their share goes to the grandkids. Okay. And usually that's at a certain age, 21, 25, some say 30. Had a client once had about 50 million. He wanted to leave it to his kids when they turned 50. I thought, a bit ridiculous. But anyway, each their own. And then it'll also then go on to say that if a child dies without children, it'll go to the remaining child. Then you'll have a reserve situation where if everyone gets wiped out, the plane drops out of the sky, there's no one left, you normally give it to someone. Most people say half to my siblings, half to my wife's siblings, okay, and all their kids. So that, in a nutshell, is your simple I love you will, okay, which most people set up. They're reasonably cheap to set up, around $500, $600 to get a will done in that nature. Okay. Now I said, why would you use a testamentary trust and a will? Now, the word testamentary trust is quite simply, it means a trust that's created in your last will and testament, hence the word testamentary trust. There's nothing magical about it, other than the fact that it's created in the will and it only starts when the person dies. Okay? Right. Now, so that you understand what a trust is, if people have spoken about trusts tonight and you might think, what the hell, trust, what's he talking about? A trust is quite simply, I give the example of, I had McKelly here, for example. I say, McKelly, here's $1,000. I want you to start up a trust where you're the trustee, your 3 children are the beneficiaries. Okay, so he's the trustee, kids are called the beneficiaries. And I say to you, McKelly, you hold that $1,000 in trust for those 3 children. Okay? That's what we call a fixed trust, which means that the 3 children have got a fixed share in that $1,000. Okay. If I change, I'm going to say, McKelly, instead of doing it as a fixed trust, I'm going to say, McKelly, I'm going to give you the total discretion as to what you do with that money. So that $1,000, you can invest it. Whatever you make out of it, let's say you make $100 income for the year, you've got a total discretion who you want to pick amongst those 3 beneficiaries and give them what you like. You can give $90 to one, 10 to the other, none to the other, whatever you want. That is the concept of a discretionary trust, which is the second thing I mentioned there. So who are the trustees, the beneficiary? In that example, McKelly is the trustee. I could, instead of saying McKelly, I could say, let's set up a company called it Mickey Mouse Proprietary Limited, of which he's the director, and that can be the trustee. Okay. Who are the beneficiaries? Well, you name who the beneficiaries are, normally family members, etc. And that's why they call it a family trust that you hear a lot of people talk about. Who is the appointer? The appointer is the person who's got the power to control the trust by being able to change the trustee. So obviously, if you've got the power to change the trustee, you dictate who runs the trust. And whoever the trustee is determines who gives the money to whoever, you're controlling it. Okay. Hence why I said earlier, where the Social Security look at it, they go, oh, hang on, are you a trustee? Are you a beneficiary? You're an appointer? You must be controlling this thing. That's going to be part of your assets to work out in the pension and all these benefits the government supposedly wants to give us. So I've just mentioned those 3 guys. And now this type of trust I've just been talking about is what I call a living trust created when you're alive. Okay. The testamentary one I just mentioned is only when you die. So they're 2 different types of trust. but essentially they're the same type of trust, the same sort of concept. Okay. Now, one of the things about a living trust is the tax man doesn't like living trusts. He thinks you're here just to try and save tax. So what has he done? Over the years, we used to be able to give our children money under a trust. Okay. And the government used to allow us to give children money, and the children were treated as if they were adults. So we could distribute income from the trust to the children and pay a lot less tax, because the kids could earn up to, say, first 20 grand tax free, and then 20%, 30%. The government over the years has whittled that down. So now you can only give a child $416 tax free. Anything over that, you pay a penalty rate of about 40%. So a family trust, a living family trust, is not the great vehicle it used to be from a tax point of view. However, there are still lots of benefits, flexibility, et cetera, which I won't go into. But the testamentary trust, sorry, I'll skip that one. The testamentary trust, you'll see that one of the major tax benefits is that they go back to the old law, which is that children are treated like adults in a testamentary trust. You say, why is the difference? Because you figure, the tax man figures you're not going to die just to save tax. Okay. No one wants to do that. And so he figures if you're setting this trust up in your will, it means you're gone and you're actually providing for your family. So he lets you have the testamentary trust with beneficiaries who are children and can earn income at adult rates of tax, right? Which is fantastic. Right? Why? I'll give you a good example. Myself, it actually happened to me. My mum left us a testamentary trust in her will. She left us a house property, my two sisters and I. We sold the house property. We each made $180,000 capital gain, myself and my two sisters. Okay. If I didn't have this testamentary trust and I had the I love you will, and I got that asset in my name and I got the 180 grand, I have to pay tax on it. Can't do anything about it. It's mine. It's my absolute property, right? Instead, because I set the will up with mum, I became a trustee for my testamentary trust for me, my children, my grandchildren, right? And guess what? I've got 8 grandchildren who are aged between 2 and 18 or 17. So what do I do with my 180 grand? I went 20 grand, 20 grand, 20 grand, 20 grand, 20 grand. How much tax did I pay? Nothing. What would I have paid on 180 grand? Probably about $70,000 tax. Big saving. Thank you, Mum. This is the sort of thing you can do for your kids, grandchildren. Okay. The significant tax benefit I've just mentioned, discretionary distribution of income, you can split amongst the lower tax beneficiaries. Infant beneficiary I've just mentioned, they get up to 20 grand effectively tax free. And you can also use what I call a bucket company as a potential beneficiary. So if you haven't got any grandkids, for example, you can still have what I call a bucket company, which is just basically a company that is a beneficiary of the trust. Okay. And you can distribute the income from the estate to that company, which one of your kids or whatever own, and they'll pay a flat 25% tax as opposed to you maybe paying 40%. Okay? So it's a discretionary thing, flexible thing that you can use. Okay. I'll just go back to this slide now. This is the mum and dad I was talking about before, and this is a typical thing I get when people come to see me about what they have. Now, what I do basically is I go through what your assets and liabilities are and what your situation is going to be when you die. In this particular case, you'll see it says principal place of residence as joint tenants, $800,000 was the original cost, value today 2.5. And I say to the clients, what happens if you decided to rent that house when you die rather than sell it? If you rented it, you might get $80,000 a year income, which is estate income if you died. Okay. That might have an investment property, it's joint tenants, worth 650 post CGT, which means you've got to pay tax on it. It's now worth 1.2. The same thing, it's rented at the moment, you're getting $65,000 a year income into the estate. Okay. Superannuation, this one had 300,000 and 150,000. Again, if that was cashed up and you just invest in getting 5%, you'd be getting, that should be 22,000 a year. Life insurance, he's got 1.7 mil, she's got 200,000. Again, you invested that cash. When you die, you're going to get maybe 5%, of 95 grand. These people had a family trust business, right? So they had a family trust that I was talking about before, which is a living trust. So this guy runs a business in partnership with this family trust as a partner. and that's worth $2 million. So again, if that was cashed up, you'd be making 5% of that, 50 grand. Add some cash in the bank, 300 grand. If you invested that, you're getting about 15, and there's a liability of $1 million. So basically, these people are worth about $9 million. Now, of course, not everyone's in this boat. You know, you could be a lot better than that, could be a lot less than that. But generally speaking, if you've got more than just your house you live in, then this type of will is something to really consider because of these benefits. In this particular case, you'll see that because on these assets, when they both die, this is the sort of money they're going to be having in the estate, $476,000 per annum. It goes into the estate. If in this case, these guys, so they had 2 5 grandkids. In that case, this money will go to the 2 kids when they're both gone, right? And they'll be earning roughly $238,000 per each child, which in the simple "I love you" will means what? Absolutely theirs, goes straight into their account. They have to pay tax on it, $238,000. If they have the testamentary trust, however, in that example I gave you, you've got son 1 and daughter 2, and they've got, let's say, 3 kids and 2 kids. They can distribute this money, this $238,000, amongst their children and try and use them up into the higher tax bracket. So the first 20 is tax-free, then it's 20%, then it's 30%, it goes to 40%, whatever. So what you do is you use up those beneficiaries first, and then when you get to maybe 30%, you then think about using a bucket company as your basic receipt of the income, so you only pay 25%. You see the big difference in saving to your children in doing this compared to if they owned it in their own right, absolutely, okay? They have to pay tax on it. There's no ifs and buts.
Just explain on that. So with the kids, obviously the threshold, but then the 2 children that are survivors of the parents, their income might only be 60,000 each as well. So there's a benefit of actually giving extra to them to top them up to the next level as well.
Correct. So what Miko's just saying is, that example just gave the 2 children, the son and the daughter I'm talking about, they may be only earning 60,000 a year, so they can give themselves more income up to a certain amount and then distribute it to the kids. Just basically it's all about using people with lower tax thresholds up to a certain level and then go to the bucket company. Okay? That's the strategy most people use in this sort of circumstance. All right. So we've talked about that. Now, you'll see that next heading, it says bloodline only testamentary trust. Now, a testamentary trust doesn't have to be bloodline only. And what bloodline only means that you're saying, in my will, it says my estate goes only to my children and my grandchildren and my great-grandchildren. Spouses, no, get nothing. Okay? Spouses are excluded. Now, you don't have to have that. You can include spouses. Now, why would you include spouses? It's another person you can distribute income to and save tax. Okay? So a lot of people still have spouses in their trusts because of that benefit. Okay. However, 1 in 2 end in divorce these days. So parents get a bit worried about their kids. And so people then start to think about, why don't we just do this bloodline only? And in our bloodline, we normally include adopted children in case your kids want to adopt, or they may not be able to have kids. I know we do IVF, for example. You allow IVF. But a strange one where a lady, she had a baby, the donor sperm and donor egg, so absolutely not her blood. And I had to change our rules to cater for that because technically that child was not a bloodline child. Anyway, so lineal descendants I've just talked about. Can you include spouse? I've just said that, but did I lose the bloodline? Keep family assets within the family. What happens if a beneficiary gets divorced? Okay, you'll see it says their trust assets are generally not considered assets or property of the marriage. Okay? Now, what that means is this: if your son gets divorced and he's the beneficiary or the trustee, if you like, of his little testamentary trust you've set up in the will for him, what our will provides is that if he goes into this divorce situation, he has to step out of being the trustee of his trust. And generally someone else will step in to take control of his trust. And it might be the other sibling, it might be the executor, whoever you appoint in the will. Okay? So he steps out, he's no longer the trustee. He's still a potential beneficiary of the trust, but so are his kids and his grandkids and bucket companies and blah, blah, blah. So when he goes to the family court, he says, Your Honour, I'm just a possible beneficiary of this. You know, I may never get anything. And it's true, you may never get anything because being a beneficiary of a trust doesn't give you any rights, as I just explained in that trust before. Remember I said there's two types of trust. One's fixed, one's discretionary. The fixed one, you have got an interest. But we're not talking about fixed trust. We're talking about discretionary. Discretionary means the trustee has a discretion as to who he gives the money to. And you could all be beneficiaries of my trust and never get nothing. Why? Because I'm the trustee, I don't give it to her. You get nothing. And you got no rights. You can't say, hang on, what about me? I say, yeah, I looked at you, but it's all right, you get it all. Okay? So there's no rights, you see. So he can go to the family court and say, I've got nothing, Your Honour. I've got a possible, I might get something, I may get nothing. Okay? So the family court going, okay, yeah, we see that. Not real happy about it. So going back a step into the I love you will, you leave 500, whatever it is, 9 million to that child, straight into the asset pool. The husband or wife said, you, I want a nice chunk of that. Thank you very much. And the family court, yes, that goes to them because you married her. You're the fool. You pay her. That's how it works. In this type of trust, no. They can't touch it. Why? Because of what I just said. You don't actually own anything. You say, I don't own it. The judge, the family court goes, I like it. See that, not real happy about it, but we'll let it go. But what they do is then the family court in their wisdom, they say, we're not going to call this an asset of the marriage because we see it's not. But we know it's something, you've got something in there, you know, something strange. So we're going to give it a different name. We call it a financial resource that you can somehow get something out of. And because you've got that, you're talking to your son who's again the we're now going to cut the cake between the son and his wife, but of what they own, a little bit more to their spouse, because you got this little thing over here. But the key is that they're not cutting the cake of what you've left your children. It's their cake. They've only got a little piddly house and a car. That's all they can cut. If you left them $5 million, they can't touch it. Okay, and then as soon as he gets out of the divorce, what happens? He steps back in to be the trustee of his trust. Happy days. And he's got his $5 million still. So I find most people prefer this even more than the tax benefit because it is a protection for their children. Okay, particularly the outlaws, the in-laws, you know what we call it. I've got that. Fortunately, one of them. I've talked about the control business here. That's the control. You step out of control while you're in trouble and you step back in. That's what that's all about. Okay. Next thing is asset protection for children. Now, this is another major benefit of the testamentary trust. The same thing applies here. You got your son, Michele's my son. He goes into a bad business deal, signs personal guarantees, goes belly up. They bankrupt him. Okay. Now, what happens in the I love you will? You've left him $5 million. The trustee in bankruptcy goes, you, thanks, I'll take that $5 million, go pay all his creditors. Michele's left destitute. With the testamentary trust, same thing. Michele has to step out. He can't be the trustee while he's bankrupt. So he's there and he says, I don't own anything. I'm just a possible beneficiary. I may get some, may not get anything. And so what happens then? The bankruptcy expires. He steps back in, takes control again. The bankruptcy people cannot touch this because it is not his asset. In the I love you will, it is his asset.
What's the time?
Absolutely owned.
What's the time frame in stepping in and out?
Bankruptcy usually is up to 3 years, but it can be extended if you've been a bad boy and not playing ball with the trustee in bankruptcy. But generally 3 years. Matrimonial, same thing. A divorce and property settlement usually takes 2 to 3 years. Okay. Now, usually, as I say, it's either one of the other siblings will take over the trust. And in our will, provide that the new trustee who takes over can't make, big decisions without getting the approval of the other person. So you can't just run off with the money. You know what I mean? So it's protected from that as well. So you see the 3 benefits there. Okay, the principal place of residence retained by beneficiaries, the 2-year rule, and Michele's already mentioned that you can hang on to the house for 2 years. If it's longer than 2 years, CGT may apply after death. So what we always suggest is that you sever the joint tenancy. Now, people know what a joint tenancy is. Joint tenancy means that if I own a house with my wife as joint tenants, if I die, she automatically gets the house by the law of survivorship, not by your will. Your will's got nothing to do with it. Okay. Now, if we want to use this testamentary trust, then we sever the joint tenancy, which means we change it from joint tenants to tenants in common. That just means I own my half, she owns her half. When I die, I leave my half under my will to whoever I like. She does the same. And in the will that I was talking about, the testamentary trust, in a similar sort of will where you give it to your spouse first, which most people do, and then spouse not around, then it goes to my kids. That's the sort of standard scenario. The same sort of will is basically what the testamentary trust will does. So in first instance, husband will normally leave his half share of everything he owns to the wife under a testamentary trust. So the wife then owns her half of everything in her own name, and the other half she owns as trustee of a testamentary trust for herself, your children, your grandchildren. Okay. And then when wife dies, her other half she owned her own name, she leaves that under a testamentary trust to your children. So your kids end up with effectively two, one from dad, one from mum. Our wills provide you can merge the two, so you can only have one if you want. You can have two, depends on what the circumstances are. Okay. And so it's a two-stage process. Okay. Look, stage one goes to the spouse normally. If you haven't got a spouse, obviously normally go straight to the kids. But normally you go to the spouse first. And that's why we sever the joint tenancy, because you want to leave half the house to the wife under the trust. Why? Now you said, if you're going to sell it in 2 years, there's no big deal. That's true, but you may not want to. And I've had it occur where, husband dies, wife doesn't want to live in the house anymore because too many memories, but all the kids say, don't sell the house, it's freaking going to be worth a fortune. The Olympics are coming, don't sell it, give it to us, the kids. And that's why they then hang on to it. Now, if they're hanging on to it, then they're going to rent it, aren't they? So if they're renting it, they're generating an income. That income, then half of it, the wife owns in her own name. She's got to pay tax, can't do anything about that. The other half, she owns as trustee of a trust. She can distribute to the kids and grandkids and whatever. And the capital gain that is made, because you'll be paying capital gains tax on the home you live in if you're renting it out after 2 years. And that's worked out based on a percentage basis on the time you own it. Okay. So the time you own it as a principal place is basically tax-free. The part you own it when you're renting it, you pay tax. Okay. And that's just a proportional formula, which McKelly will help you with, no problem. Okay, so we talked about that. All right, now this is an important one too. You find a lot of people have what I was calling before a family trust or the family discretionary trust, which is the one I said that the taxman doesn't like, and he only gets you $416 for kids that you can give them money as a distribution of paying no tax. But what do you do with those trusts when you die? Because trusts keep living when you die. Okay? So, for example, I've set up my family trust. I'm running my legal business out of the family trust, and then I drop dead. Trust doesn't stop, keeps going. Okay? Trust normally lasts for 80 years, but now the law changed last year. It now lasts 125. You can stop at any time, of course, but it can last. So a lot of clients then have a dilemma. What do they do with their trust when they die? And generally, what do? Give the control to your kids. In this example, we've got 2 kids. Giving one trust to 2 children is not a great thing, is it? Why? They're going to make decisions every year who gets the money. And you'll find that if they're both married, they've got husbands and wives in their ears saying, he doesn't go cut the grass, the block of flats. I do that. He's a mongrel, why are we giving him money? And all you're going to have is the kids fighting. So control to the 2 children, not a great idea. Giving control to 1 child, is that a good answer? Possibly, but then what happens? Inequality. He got the trust, I got the block of flats, but his is worth 10, mine's worth 1. Unhappy days. Okay, all shit happens. French. You can have an agreement to say we're going to agree, 2 kids are going to agree that we're going to split the money 50-50 every year. Okay, that sounds reasonable, doesn't it? Unfortunately, the law is that a trustee cannot fetter his discretion. That's the word there, see, fettering discretion. In other words, you can't preempt what you're going to do every year. You've got to say, no, every year you're supposed to sit down and go, right, I've got a discretion. I'm going to consider all these people. Yeah, I looked at him, yeah, no, I'm gonna pick this one, okay? You can't say, in the year 2030, I'm picking him. You can't do that. You've got to do it every year of the 30th of June. Okay? Now, people still do this and hope they get away with it, and often the taxman doesn't check. They don't really worry. Because remember, everything is self-assessment. When you lodge your tax return, taxman believes everything you say. Till he audits you. Then he doesn't believe anything you say. So, you know, you could have this voting thing, but I don't recommend it. Another one you can do is cloning the trust. Remember cloning the sheep, that thing? Same sort of thing. You've got a trust and you can say, let's set up a new trust, call it a clone number one, right? And I'm going to transfer half the assets from this trust to this trust. So now this trust owns half, this trust owns half. I'll leave this trust to son, this trust to daughter. Good, isn't it? Because this guy runs his own show, she runs her own show, right? Only problem with that is you actually got to convey half the assets to this trust. And what are you doing then? You trigger capital gain on money you don't actually get. Okay, because you're transferring half an asset to this trust. Okay, and there'll be capital gain to pay tax on, and potentially stamp duty, which is over 5%, which is not to be sneezed at. So again, cloning, not real flash. Hybrid trust, creating a hybrid trust to manage your interest. Again, I've got there will attract CGT. It's a similar sort of thing, but what in that case, what happens? You've got a discretionary trust, which we talked about, the simple family one. And instead of having the discretion, we changed the trustee to say from now on, we're going to create 2 units, if you like. One unit is like a share, it's going to be held by him, one unit is going to be held by him. And each of those units can decide who amongst their family group they want to give the money to, and he decides amongst his family group. That's what's called a hybrid trust. But to do that, the tax man says he believes that that's creating a capital gains tax event on which you pay tax. So again, you're paying tax on money you don't actually get. Waste of time, really. And look, the final one then is probably the only one that's most logical, and that is vesting the trust. That means wind it up, sell everything, cash it all up, right? And then give it to your kids in their testamentary trust. Because then they've got the benefits of the kids earning up to 20 grand, etc., which they don't get in these trusts. Okay? So that's the one most people opt for. Is it easy to run? I said, yes, absolutely. Bank account setup, tax compliant. So it's pretty simple. I know it looks complicated when you see these documents, you know, the will's about 30 pages long and there's all this garbage in it about how it runs and all the rest of it. But it's basically pretty simple in the sense that, you know, husband and wife, husband drops off the perch, wife comes in to see me, so what do I do now? So it's quite easy. Get the will that we prepared, go down to the bank. So see this will, it says, I'm the trustee, the wife, I'm the trustee of the Mickey Mouse Trust. Open me a bank account. Bank opens a bank account. So it's, you know, Mary Smith as trustee of the Mary Smith Trust. She comes back, what do I do now? So easy. See all these assets we got over here? Half of them are going to you now under this trust. So whatever you're going to do, cash up, whatever it's super money in the bank, whatever, put it into that account. And then with that account, go and do things. Whatever you want to do, invest it, whatever you want to do. End of the year, you come and see McGelly for your tax and say, here's my bank statement, what do I do now? He says, no, I'll prepare you a trust tax return. Okay? He does that, works out what the income you've earned from that money you've been left in the estate, works out the income and says, right, what do you want to do with it? So I've got 3 kids, I'll give them that. Oh, what else? Oh, let's go to the bucket company. Yeah, beautiful. Finished. That's it. Next year you start again, do the same thing. Now what happens when you both go? Kids come in and do the same thing. So go down and open the same will, don't have to go any more documents, nothing more to prepare, and open a bank account as Bill Smith as a kid, as trustee of the Bill Smith Trust. Same thing, you then put everything into that account. And he does exactly the same thing. So it's not rocket science, it's pretty straightforward, really. That's it. One thing that McGelly mentioned and everyone's mentioned is this 5-year thing. And I think you need to always consider that very strongly, depending on what your ages are and where you're at in life. But if you're going to plan, you've got to plan for it as early as possible. Don't wait till it's too late, then you're at 65. You can, as McGelly said, and they all said, you know, you give away $30,000. It's ridiculous. In other words, you can give it away, they still treat it as if you can give away $1 million, but they'll still treat the $970,000 is yours, even though you've given it away for asset, for pension purposes, etc. So you've got to do all that preferably before you're 60, so you can get rid of whatever you want to get rid of and reduce your estate assets, which is what Sebastian's going to talk about shortly. Finally, I haven't mentioned here, but everyone should have an enduring power of attorney, and if you don't have one, then get one. Why? Because if you don't have one, the public trustee can take over your affairs. You might think your spouse can look after you, they can't. The only way they can look after is they have to apply to the QCAT, the tribunal, to be appointed your guardian. And unfortunately, you're competing with the public trustee, and you've got to convince them, the tribunal, that you'll do a better job running their financial affairs than the public trustee can do. And guess what? Courts tend to think the public trustee is pretty good, even though he's pretty crappy, I think. And they usually get the Guernsey. So if you don't want to have that happen to you, then have an enduring power of attorney. To me, it's an insurance policy. You keep it in the drawer, hope you never use it, as long as you don't lose your marbles. But if you lose your marbles, it's there. Someone's going to be looking after you financially and health-wise. Okay? Very important document. Now, that's a document separate to the wills, obviously nothing to do with the will. Power of attorney is when you're alive, wills when you die. All right. Any questions? Yeah.
Is the, with setting up the testamentary trust, is most of the cost in setting it up or the ongoing?
No.
And then, so is the best age, like that example that you gave, how old are they, for example? Like,
That was 60, but look, there's no.
the people my age set that up.
Oh, yeah. Look, as I said, the question is more, what's your asset position? You know, if you've got 2/5 of nothing, obviously not much point. If you've got something, you've got a reasonable asset base, no matter what age you are, and you've got kids, you know, you can be 30, you can be 35, it doesn't matter. If you've got something, if you've got nothing at the start, I mean, you got your stereo and, and your record collection, not so good, you know. But anyone who's got a reasonable asset, they've got a home they live in, and if you've got an investment property or something like that as well, or, you know, you've got your super, you've got whatever you've got, you know, then it's worth considering that type of will. Now, extra cost? No, there is no extra cost. Once you set this will up, hopefully it can sit in concrete for the rest of your life, because the will basically say everything I own will go this way. You don't have to say this house goes to that kid and this one goes there. You can do that, of course, but if you do that, if that house is not there when you die, then that gift is useless. That's why most people just say, I leave everything in particular proportions or shares. Okay? But no, there's no extra cost. And as I said to you, the will is it. You don't have to go get another document drawn up. Whether it applies to the spouse in the first instance or to the children, it's all in there in one document. Same document goes to the bank, you open the account. That's it. And then the only ongoing cost is the annual trust tax return, which would be billed at the account.
So just to clarify that, so if Ian bought another property.
Yep.
Doesn't have to change or update the will or the.
If our will said everything I own when I die goes to wife, she's not around, my kids, they're not around, my grandkids, which is basically I love you will, just that we transported it into this testamentary trust concept. And so when they get it, they're not getting it in their own name, they're getting it as trustee for all those people. But they run it, they control it, it's their baby. They do what they like with it. If they don't want to give it, like if you say I give to my wife as trustee and she says stuff the kids, I'll give it all to myself, she can, because she's the trustee. She can do what she likes, totally discretionary. Yeah.
Do the properties have to be put in a trust name? Or do they remain in your personal name?
Eventually on death, remember the will only starts when you die. Will the property stay in your name until you die. When you die, what actually happens is there's a period, what we call the executor's year, where executors are supposed to collect the assets, pay the bills of the estate, and then give it to whoever the will says to give it to. Okay? That's what's called the administration or executor's period. Okay? When that period's over and he's done his bit, he's paid all the bills, paid the tax, whatever had to be done, and he's now got the assets left, he then is supposed to transfer it to the beneficiary. In this case, if the beneficiary is a testamentary trust, it goes to that person as trustee. So you could find a property, for example, say you're leaving your assets to your 2 kids, right? and say, I'm the executor. You leave it to the two kids, so I'm the executor. So what happens is, when you die, that property of yours gets transferred to me as what's called the personal representative of the estate or the executor, right? I pay all the bills, whatever. Now, often, sometimes the beneficiary say, we don't want to keep the property, sell it. So the executor sells it, gets the money, whatever the money is then, and then gives it to the beneficiary. Or if it's not going to be sold, after the executor's year's up, basically, the executor then says, right, now I've got all the assets, everything's been paid. Who am I going to give it to? Oh, your two kids, right. So I'll now transfer that property from my name as executor to their names as trustees of their respective trusts. So it'll be Mickey Mouse as trustee of his trust and Donald Duck as trustee of his trust. On the title, that's how it will show. Okay. And when they look for the trust, it's in the will there. And the will actually gets lodged in the titles of it. People can see it, search it.
Just in Danny's case, so say for example, he's got a couple of properties in one property trust, another couple of properties, another property trust, a couple of in his personal name. Same situation, right?
Well, the ones in the property trust he's talking about, you've got this problem. Hang on. That one. What do you do with those properties? Because they are not in your will. Do you understand? They are not your property, not your personal property. They are your trusts, your living trust. Remember I said there's a living trust, the testamentary trust is in your will. If you've set up a property trust that owns 3 properties, right, and you die, what happens to that trust? These problems. Do you give it to the 2 kids? Do you give it to 1 kid? Do you give it to, where do you give it to? Right? That's your choice. Now, in most scenarios of a property scenario, let's say you two, your husband and wife, eh? Yeah.
53 years.
You poor bugger. One of you. In a normal property trust that just owns property and it's husband and wife, you don't really need to do much. So if you drop off the perch, what normally it'll say is control of that property trust goes to her. Okay? The question then becomes, then when you're both gone, how many kids you got? 1, 2. There you go. You're going to leave that to the 2 kids? Are they going to have these fights? Is he going to say, you didn't mow the grass, I mowed it, why should you get the bloody money? That's what happens. I've seen it happen. Believe me, I've been doing this for 45 years. I know exactly. So you don't want to give them that risk of fighting about it.
Give us some clues on what you do.
What you do?
Yeah.
Well, as I said, basically
No,
vesting.
no, if they don't talk to each other, give us some clues on. What do we do? Do we leave one out of
Oh,
the
no,
will?
look, leaving one out, that's another headache and a half.
Well, that's it.
Let me just give you a quick thing on leaving people out. Even if you, as you may or may not know, we have a law in Queensland and in most states that says that if a child or a spouse feels that they have been left without adequate, and the words are maintenance and support, adequate maintenance and support. That's what the government put in the law. What does that mean? Whatever a judge thinks it means. And basically what it means is that they're saying, Mum and Dad should have left me more. So even if you get 50-50 and 2 kids, one of them can say, hey, I should have got more. Why? Because I need it and the other one doesn't. And the court in their wisdom can actually change your will and give them more. Right? And you think that's ridiculous, but that's our law. Why did the government do that? They don't want to pay pensions to anybody or unemployment. They want you to look after your own kids. It's a horrendous law, but it's there. So if you're ever thinking about cutting a kid out, think twice. Even when you give them equal, you still got a problem risk that they can still try and go to court over. You're gone, at the end of the day, they fight, they're going to fight between themselves, nothing you can do about it. And what happens is if, say you, the property trust, you said, if we both go, then I want the trust to invest, which means it's got to be sold. Whatever the assets of the trust are, they sell it, cash up, pay the tax, and then you give it to them and then they do their own thing under their own trust. See? And people say, oh, I've got to pay tax now. I said, yeah, but hang on. Some way down the track, you're going to pay tax, aren't you? All you're doing is bringing it forward when you die. You know, big deal. And you can put in the will also that your 2 kids can bid to buy the property off the trust. Because remember, they're going to get half of it anyway. So they're only buying half of it. And I put provisions in wills where they say, you know, we'll put it in a hat and whoever got the best offer wins. Sort of thing. I get it. Because you get that sort of rivalry. I've seen that happen too. Terrible. But yeah, they're all the problems you got in wills that you need to think about. That's about it. I think. Anyone got any more questions?
You mentioned one downside, I think, downside of a testament trust where the wife gets everything and decides she's gonna keep it all herself.
Yeah.
Are there any other downsides?
There is one downside that if a property goes into a testamentary trust, the land tax you pay is at a higher rate because natural people pay land tax to a threshold of 600,000. Over that they pay. Trusts have that threshold of 350. So an extra 250 grand land tax you'll be paying. That's a negative. But you don't weigh up. You can't have your cake and eat it all the time. So that's not so bad. If you're worried about your wife running off and marrying a Filipino bloke, then you need to think about what we call a contract for mutual will. Right? What that is basically, husband and wife share their wills, so it's going to go to each other and the kids and the grandkids. When they sign this contract, it says we're never going to change those wills unless we both agree to change them or we get divorced. The reason for that is then that if one of them decides to marry a Filipino and they change their will and leave it all to Filipino, the Greeks, could be Italian, could be anybody.
Tell them to just kill them.
Then what happens is if they do change their will, the estate of the person who signed the contract, which usually the kids, can sue the other person's estate and say, you breached the contract. You've suffered a loss because what we were supposed to get now is all gone to these guys. I want you to pay me the damages. Now, it's a tough case to run, I can tell you, because, you can't stop your spouse from not spending the money. Right? You know what I mean? If they want to spend the money on themselves and have a good time, well, that's fine. But the idea of it is it's more like a stick to make them sort of realise that, no, they're not doing it. We also say in that document, if they're going to form a relationship with a third person, they have to sign a financial agreement with that person that says they're not going to touch what you've got in your estate. Okay? That's just another stick. Again, it's all contract, breaching the contract. Yep.
And during power of attorney, when would somebody not require one? I mean, like you said, not if they don't have assets and they're young, but if they're getting into middle years, would it be an idea to do it then?
Oh, look, everyone should have one.
Everybody should
young, even these young guys at the back here. Yeah. I had a secretary in my office. Her brother was 21, fell off a horse. He was in a coma for 12 months, and they had to keep going to the public trustee. Can I now pay his bill for this? Can I now pay his bill for that?
What's the cost for a power of attorney?
Power of attorney is about $500. Good investment. Insurance policy.
Set it once and for all.
Yeah, well, you can change it as long as you don't lose your marble. You can revoke it and add people, change it, whatever you want to do. But if you lose this, you can't change anything. If you lose this, you also can't change your will. Although there is a provision under our legislation that allows a person to make an application to the court for what is called a statutory will, where a judge can actually make a will for you if you've lost your marbles, if he can be convinced that you would have made that sort of will had you had your marbles. Right? And a good example is, let's say husband's lost it, wife comes in and says, I'd like to do this will, it sounds good, I've got the simple will, I want to change to this. And so the wife changes to that, and she says, my husband would have done it too if he had his marbles. And say, good, let's go to court. So we go to court, we say, Your Honour, look, the wife changed it, that's what she wanted, and it's quite obvious he would have wanted it too. Will you change it? He said, yep. And he makes the order and creates a will, not signed by the guy, but it is a will that binds the estate. Yeah. Unfortunately, it's a costly exercise, but. All right. Anything else? Sorry.
You can give what you will, so that the beneficiaries can decide whether to receive their share through a testament trust or direct.
Yep. And answer that. He said, can you have it where I don't want the testamentary trust? Yes. Quite simply, the will say, if at any time beneficiary says, I don't want the trust, I want the money. If you don't, give it to them. That'd be foolish. But yeah. Why would you want to do that? It's crazy. Just another quick thing I'll tell you. What happens is, in this example, you give the money to your kids, and say you left them $3 million. What do most kids go and do? They'll go and pay off their mortgage. Or buy a house. Now, if they go and buy the house with the money you just left them in this bloodline testamentary trust, what have they just done? They've converted what you've protected into something that can be attacked by the wife spouse. But how do you do it? What you do? When they come and talk to me, I say, no. What you do is you, wearing the hat of the testamentary trust, lend the money to yourself and take a mortgage back for the money, so that when the spouse ever attacks you, you've got a nice big fat debt, has to be paid back to the testamentary trust. The family court can't touch it. The equity, of course, will maybe go up, and they can't stop that. But see, those little tricks they need to know, and that's why, everyone's saying, I don't want the trust, they'd be fools. But stop.
What sort of money we're talking about to set up?
I charge $4,000 plus GST per will, about $8,000. To assist my clients, I break that bill up, half of it as tax advice, because you'll see I've just given you a heap of tax advice. And so that's tax deductible too. A lot of food for thought.
Okay, now, thank you very much.
Thank you.
What we're going to do here in this final section is just wrap it all up a little bit, go through some more aged care planning exercises, just to bring it back to the core sort of focus of tonight's session. As a financial advisor, some of you obviously have an advisor that sits alongside your accountants and your lawyers and but a lot of you don't even know maybe what a financial planner does. So this little slide here just really explains to you what I do day in, day out with my team, of course, and how we help clients every day achieve their financial goals. Okay. We try to use more sort of, common language around these things, but protection for your family, life insurance, wealth creation for the future, superannuation, retirement savings, how to use your super and your assets to provide retirement income, building a legacy, estate planning is what else is went through. Risk management for business owners. This is where we have, business owners who have partnerships and the like, or key persons in their business, and they want to protect those assets. And obviously aged care planning, which you'll see a lot of financial planners now starting to really ramp up their service offering in that space. And so it's not just about investing your surplus cash flow. There's a lot of strategy, a lot of advice that goes into what we do every day. So regarding aged care, what our goals are to help our clients is to help reduce aged care costs, to hopefully improve age pension outcomes if possible, and even more importantly, preserve capital for the families and the estate. And that's what then that will lead into those other strategies around estate planning that helped us spoke about. So by trying to achieve those things, we try and implement effective financial strategies. Now, these are a few of strategies that we can help to implement, whether it be all in one go or over a period of time, but all with the aid of helping to reduce aged care costs, okay, and increase income and those outcomes that we're looking for. So retain the home, reverse mortgages, move into aged care separately if possible. Maybe a couple living separately and apart, paying the RAG compared to the DAP, which is what Marcus spoke about. Maybe getting a loan secured against assessable assets to help reduce those assessable assets. Establish a granny flat right. This is becoming more common these days, and there's a lot of complex and in the government's wisdom, they want to make things complex, which makes it difficult for all of us to grasp. But there are certain rules around creating those rights and how they impact your assets. Gifting assets, we've already spoken about. Funeral bonds and burial costs, there are some exemptions around those things. So if you plan ahead a little bit, it can help the situation. Looking at things like annuities, Challenger here, Marcus's team have created quite an innovative annuity for those entering aged care. It's called Care Plus annuity. That can help reduce the assessable assets. And insurance bonds held inside trusts. And that's all about working through that control and ownership of the asset and the income that flows from that to hopefully reduce those, means tested care fees. I won't spend a lot of time on this, obviously, because just conscious of time, and obviously everyone's been very patient and very helpful with time frames tonight. But essentially, these strategies are what we can work through to help improve anyone's single situation. But it's all tailored. It's all defined by your circumstance, your asset base, your family arrangements. But we're seeing that more and more people are seeking this assistance. And it's not because I want to sit here and charge clients, money for my services, but it's becoming more complex as our lives get bigger, bolder, and as the government increase complexity into the systems that receiving advice not just from a financial planner but from a lawyer, from an accountant, is now becoming quite needed. So what we're going to run through quickly here, the bit of a case study to help just bring together these numbers and focus on the strategies a little bit. So Theo here, he's got a home worth $1 million. He's got some investments worth 150 grand. Could be super, could be anything else. He has super as well, 300,000, and he has some cash at bank about 120 grand. So Theo's moving into residential aged care next week. Regardless of his income and assets and the amount of age pension received, he will pay the basic fee that Mark has explained before of $65.05 per day. Okay, this gets indexed twice a year. Okay, but there are questions that are going to be asked about what he actually wants to achieve and what he has to consider. Does he have the capacity to make decisions? Does he maybe have an enduring power of attorney that's coming in and making the decisions for Theo? Who is that enduring power of attorney? Okay, you need to create a relationship and an understanding of what they actually wanting to do. What are his personal or family objectives? That comes in around whether the home needs to be retained or the home can be sold potentially. Is there a protected person living in the home? So is there a spouse or is there someone like a child that's in the house helping to care for that person? Additional home details. So even though we all have properties and we might just want to sell the house or retain the house, but there's some things to consider. Sometimes to get the house ready for sale, there could be costs. To make it rentable, there could be costs to bring it up to a livable condition. A lot of the family homes, most likely could have been held for 30, 40, 50 years and very little maintenance maybe over the years has been actually done on the homes. Is the super pension tax free? So moving something that was exempt from tax to a different environment, how does that change the tax situation? And is there a cash reserve and should they have a significant cash reserve still? So all these questions need to be asked and answered and discussed before we even get anywhere close to understanding what the cost is going to be and whatnot. So in this case, Theo has these assets. So like I mentioned, he has a pension and super, he has some cash, he has a term deposit, family home. And for the aged care assessable means test, his asset value will be calculated about 780,000. The home is capped at that 210,000. Okay, so the home's worth $1 million, but for aged care costs, it's only about at 210. The income test, right? Because we're assessed under the assets test and income test. The actual income that's deemed to be received is not to the actual income. So you could be achieving 10% returns in your term deposit, but the government actually don't use that particular rate of return. They use their deeming rates. Okay. And that's those deeming rates coming into play and working out that roughly your income is about 24,000. You actually might be earning 50,000. Okay? It depends. So your means tested amount, when those two sums are added together, divided by 364, calculates your means tested amount. Okay. Now we take that number, and that's how we calculate how much you're going to contribute to the hoteling supplement and the non-clinical care contribution. Okay. So in this case, in this scenario, Theo is going to be looking at paying the maximum daily amount. Okay, because his means tested amount of $146 at this line here. Okay. Less the supplement, less the hoteling supplement equals that $53, but he's capped at paying $105 a day. Okay. So every day of the year for that first period of time, there are lifetime caps these days, no longer annual caps, and that's where Marcus mentioned that $70,000. That's basically where that is calculated from. That's what Theo's going to be paying every single day that he's in aged care. Okay. The RAD and the DAP, like Marcus said as well, that's a separate consideration. And how we're going to pay for that obviously requires a bit of planning as well. Are we going to have to sell the home? Are we going to pay the DAP instead? Because the home might be, more valuable in a few years' time, depending on the market conditions and what the family objective is. They might have had a family home that's been passed down through generations, and they want to keep the home for the next generation. Okay. So in Theo's case, yeah, it's paying that hotelling contribution of $20.15 per day and the NCCC of $53.25. Okay. Then, so these are the rules of thumb. Okay. If you have assets of more than 252,000, you're going to be paying the hotelling contribution. Okay, that's that $22.15 per day, up to the maximum contribution of 355,000. The non-clinical care contribution, if you have assets to the value of 532,000, you're going to be paying that non-clinical care contribution. Okay. These are just rule of thumbs. It is a combination of these sums and income tests. But these are some of the sort of rule of thumb. So if your income is over 100,000, you're paying the hotel contribution. If your income is over 139,000 for a single, you're going to be paying or contributing to the cost of your care. So Theo enters an accommodation agreement and liable to pay the published rates or the refundable accommodation deposit of 370,000. They can do this either by paying a lump sum, right? And also, as we mentioned, the estate, or if he leaves aged care within 5 years, after 5 years, there will be that retention amount of 2% per annum. Or you can pay a daily accommodation payment, which, like Marcus mentioned before, is calculated based on an interest rate multiplied by the station deposit and paid daily. Okay. So what are some things that maybe Theo can consider around paying the RAD or DAP? So like we mentioned, if the home is sold to fund fees, what's the impact on Centrelink potentially if he is entitled to any pension? If the RAD is exempt for age pension, but residual proceeds and other assets will exceed these thresholds. So we've got to be mindful of those different, tests between the age pension and how aged care is calculated. If the home is sold, the impact on ongoing fees. Again, assessable assets become assessable assets. And practical considerations are reselling the home, like we mentioned. Is it ready for sale? How long is it going to take to sell? Life expectancy in care. Unfortunately, this is actually quite a common eventuation when we're having conversations with clients. The family will come and see me. They're not too sure what's going on. They know they have to put mum or dad in care very soon. And, the family come together, we're sitting around the table, we're discussing all these different components of what could happen, how much it's going to cost, and everyone's sort of freaking out about how they're going to pay for it, right? And how they should go about it. But unfortunately, what we do find is that a lot of people that are ready to enter aged care, especially, are going in because they're not able to stay at home. They're not able to be securely cared for at home anymore. And that means that we're making all these big decisions, all these crazy hypotheses and scenarios about the what ifs, and unfortunately the person dies very soon. So yes, planning is important, but and that's where getting information and coming to sessions like we are today, reaching out to your advisors, asking questions about how these things work, so you can be ready and a bit more enlightened. And unfortunately, it does happen that a lot of stress and a lot of anxiety occurs around these planning moments. So just be wary about that stuff. Factors in RAD, factoring the RAD retention versus non-refundable DAP that will index. It's becoming a quite interesting concept around, and this is where we don't have a crystal ball, so we can't say how long you're going to stay in aged care, right? But if it's likely that your journey or your experience in aged care is going to be quite short, potentially paying the DAP might be a better option. Okay? It just depends on that retention rate. Estate planning. So again, how's that going to be treated down the line? And even further than that, how are those assets that will be left, how are they going to be structured for the next generation? Okay, a lot of us are talking about what's happening in our lives today, but we have to probably start thinking about what's going to happen down the line. Those assets are going to be added to the pool of our children, potentially our grandchildren. And if they're looking to go in aged care very soon as well, potentially, then we're just exasperating and passing the buck, making it a lot harder for everybody, making the costs even higher for everybody else. So basically, yeah, the sort of fourth part of the care structure is this the high everyday living fee. Marcus has already gone through that a little bit, so I won't harp on that, but it is at least a bit more of a fairer system now. Used to be a little bit that's what you're paying, and unfortunately, or good luck basically. But now it's a little bit fairer, a bit more voluntary. So in this scenario with Theo, around whether he keeps the home or vacates the home, you can see that we've been able to achieve a better outcome down the bottom here in terms of net cash flow. But that's because we're able to achieve a greater income support outcome. Not necessarily because his care fees are generally going to change too much. In this situation, they will, only because the non-clinical, the daily accommodation payment has been paid now by him paying the RAD. Okay, if he didn't pay the RAD, he was paying the DAP. That's why this rental payment here is here, and that's what the difference is. So having that conversation about do I pay the RAD or do I pay the DAP has to be considered very, 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 very acutely. But if we extend this a little bit further and we start talking about whether the different scenarios around whether it's vacant and you're paying the RAD, and we're going to now introduce some strategies around annuities, around funeral bonds, et cetera. Essentially, what we're trying to achieve as advisors to help with the situation is to try and get this bottom line, as manageable as possible. Never always going to be perfect. It's never always going to be, flat, like in that scenario there where we got potentially protected person living in the home. That's under a particular scenario. But what we're trying to achieve here is to work through the different income streams, the different strategies, to eventually work out what's going to be manageable long term. Okay, and this is where the complexity comes in, because we've got so many different avenues, so many different opportunities and solutions that can work depending on each individual's circumstance, I guess. So obviously, as advisors, what we try and do is add value, like I mentioned, improve cash flow, improve capital preservation, because unfortunately, and fortunately, we are living longer. So that risk, what we call longevity risk, around living a little bit longer or living past what your assets and income are going to be able to provide, is all about what we're trying to achieve and create certainty, a little bit peace of mind for you guys. Give some certainty around the cost of care. What are these numbers going to be? What are the tax implications if we need to sell assets, if we need to, especially around the home. Okay, the home is quite a powerful asset where we have exemptions around tax and etc. But we need to work through that, and the estate planning, making sure that all our clients have proper estate planning. And that's why we work really closely with our office, and also with McKelly's office around these issues, because without having that full circle, that full network of advisors and professionals in the corner, you're going to leave something off the table, unfortunately. But obviously, I'd just like to say thank you everyone of you for coming and spending the time with us tonight. Hope you will take away some nuggets of information, some gold nuggets there. I thank Marcus, Michelle, McKelly, and Elf for your time as well. These things